I want to welcome you all to our Thursday call. Thank you, all of you. Those of you know me, are clients of mine. I hope all is well. Typically, our format is we're really about education first, showing people what's going on, helping people to understand, separate maybe what they're currently doing, separate some of the emotion from, what we see in the horizon. Also, we typically are not trying to sell anything here. We're trying to ask you to put your wallets away, checkbooks away. We're definitely not a hard sell. Sometimes some product conversations will come up, and whether it's with us, I am a partner with, as you can see, my shirt Eagle team. We were recently acquired by a larger group on our educational side. We have a bunch of advisors, about 100 of them across the country. So that was great news, and that happened earlier in the year. And we're just developing and creating more and more resources for all of us that are in the field working with clients that are approaching retirement. This topic is hindsight's 2020, and we're meaning that we're always a month behind. So we know that June was, even though it says July 2022 and we're 2 weeks into it, we took a snapshot of June, and we're always a 1 month behind playing Monday day quarterback to look at, what's going on in the economy. Can we take from that anything that we should be concerned with on a go forward? And it helps, I think, to prevent some of the knee-jerk reaction that many studies have shown that a lot of people that try and manage their own portfolios, and advisors as well, are typically emotionally driven. So let's go ahead and get started. These calls typically last 15 to 20 minutes. And again, apologize for a delay. So I want to tell you, where was I last week? I was in Alaska. I didn't plan on going there. By dumb luck, an opportunity presented itself. That's one of my business partners. There's where in Alaska we went to, Bristol Bay. Absolutely. I will recommend, if anybody on this call has an opportunity to go to Alaska, you should absolutely take advantage of it. Those are salmon that I actually caught, and we flew home and are in my freezer ready to share with my family. There is a bald eagle. To be perfectly honest, I know some of them are here. I know we got a couple around Allentown, New Jersey, but they're pretty prevalent there. It was pretty cool to see, very majestic. I thought this next slide was pretty cute because we're in the woods, but we've entered a bear market, right? So I saw plenty of brown bear, grizzly bears. They're really the same bear, depending on where you are in Alaska. But we were able to go over to Brooks Falls. I actually took a little water plane that, actually lands on the water. And in my skill set, was able to negotiate with the pilot to actually let me fly it while I was there. It was very, very one of my dreams to be able to do that. So there was 2 yokes there. I was sitting in the co-pilot seat, and he let me take the wheel for a little while. That was pretty cool. All right, so on to business. So how's June look? As we look, and you go, wow, the markets are down. So if you are not familiar, right, this is equities, growth markets, and whether it's the S&P 500, each of these are color coded, right? And this is when we talk about total return. Total return means that not only are we getting growth or losses of the actual stock, but any dividends that some of those stocks may offer. Now, S&P is what we consider large cap. They're typically the most resound and proven American companies. So that's one of the indicators that we see. And then the other one is the Dow Jones Industrial, right? So this is more of your industrial type stocks. There's only 30 of them on the Dow. And then next we have Russell 2000, which is total return, but Russell 2000 is small cap. So smaller companies that are, out there day in and day out. And you can see that's actually one of the ones that's been struggling. But it's everything is mixed up here. And that's why I'm reading them from the top. So you understand where you go and look, which is done better versus which is done worse. The teal green here, this light green, is total return with European markets. So when you see MSCI, EAFE, this is Euro, right? So these are developed countries in Europe. And then you have emerging markets. These are undeveloped companies. I typically equate this to China, Indonesia, clients, Malaysia, things where we're not typically in the past, they've gotten their clocks clean. But actually for the month, they were the least of the ugly performers. And then you have commodities, which the commodities actually are down for the month. And oil prices, we all know that we're feeling inflation at the pumps. And then you have real estate, right? Which is everybody was touting, but it was doing okay in the housing bubble, everybody's houses, we recognize it, but we've been watching. And remember, real estate, especially when you're dealing with REITs, right? Real estate investment trusts and things of that nature. This is a total return. So this includes a lot of commercial buildings. And think about it, there's a lot of landlords or people that own buildings that have lost a lot of tenants. So where people, I've gotten several phone calls in the last couple of weeks of people looking to explore into real estate. And to me, I don't have a favorite, right? If it makes sense, perfect. But what I want you to understand is that there are risks involved. It is not like printing money. And, human beings typically have a 24-month look back memory where they forget the pain of something like 2008. So this is just for 1 month. And as I've said, although we have a year of data, we know that most portfolios, you only need to look at your 401k, your brokerage account statements, and know that we've been under pressure, right? So this is why I still believe equities are something that we need to hold on to if we don't need the money today, tomorrow, right? If there are losses in a portfolio and we don't sell, then we have not experienced any losses. And that's one of the things that you got to really make sure you understand is that we are not, it's very difficult, if not impossible, to time the market, right? Many studies have been done where if you just let the market do what the market does, and we do remove some of that emotion from it, and that's part of what I view my job as, is helping you to manage emotions. So, if it's not that I want to just stick to something, that's ugly, if we have to, or we want to, or feel it's appropriate to get out of a area, right? So part of the adjustments I've been making with clients along the way is getting out of the NASDAQ, the tech sector. That is not really done great. It's not on this chart, but in some of the portfolios where the tech was all the place to be for the last 2 years, 3 years, and was showing promise, it's hit road bumps. So just keep that in mind. So let's look at what year to date has to say for us. Year to date tells a little bit different story, right? Commodities, which were all on a tear, right? Everybody was like, oh my God, I need to be in commodities. This is typically oil laden, which is why we've seen this upward. But you can see in the last month here, right, that, oil prices, price per barrel, even though it's still expensive at the pump, has started to fall off. But everything in the equity market right now is down, right? So I have many charts, have looked at this many times, that although we are down now, when you take more of a macro view, over time, it does recover and it typically goes to higher highs. That does not mean, like I said with my first slide, that we've entered bear territory, right? And you'll see that on the last slide. That's 2 consecutive quarters with negative GDP. That has happened. All right. So as all the talking heads, the politicians can say whatever they want to, at the end of the day, our portfolios are going to follow trends, right? So right now, one of the mistakes I think a lot of investors make, they know the adage, which is buy low, sell high. Yet they always seem to be, because it's emotionally driven, and the study Dalbar has done many studies on this as well, that people get out at the wrong time and then end up getting in at the wrong time. So inadvertently, what they're able to, or unknowingly doing, is that they're buying high and selling low, which is really ass backwards, for lack of a better term. So here's our bull bear indicator for the S&P. We hit a red line, right? So, and what that just basically means, in the past, before we turn up, I don't think we're going to be back to 2008 data, but you can see we had a flash crash here when COVID hit, right? Right prior to that, we had some other pressures. Overall, I do think we need to be cautious, right? But this actually is an opportunity to start stepping in and dollar cost averaging into the market, into equities. I like equities. I think the American economy is going to rebound. If you're in a 401k and you have the ability to continue to contribute to your contributions, I would absolutely encourage you to continue to do so, right? And because what you're doing is, although the total value is down, you're buying on the way down, which will have positive impact when it turns around and recovers. So that's where, we really feel that that, dealing with a professional advisor, talking through some of the decisions you'll be faced with is prudent. All right, so now let's go over to the income market. So for the month of June, let's just start off with, again, zero and everything is down, right? So we're going to go through these US aggregate bonds. So these are total returns for the bonds, right? Including the promise rate and the coupon rate. Then we have iBox high yield. My eyes are getting old. So this is total return high yield corporate bonds. So again, this is another word. When you see high yield, substitute that for junk. So that's that yellow one. So notice that's at the bottom, right? And why is that? So let's stop there. Bonds don't like rising interest rates. Well, what have interest rates been doing on a tariff for the last 3 months? They've been going up, and the monthly indicator demonstrates while somebody has bought questionable paper, which is bonds, that now their portfolio, and this is why I'm a huge proponent of having bond alternatives. And if you've been on this call and heard me, I'll preach that until things change. 7-year treasuries, right? So we got the blue there, not awful. That's typically safe money. Vanguard Total Return ETF. This is international bonds. So we have, we're also, that's not awful. It's in the middle of the pack, so losses. Vanguard Total Return International. We got the 20-year treasury, also safe money. So it's right in this hunt here, the hot pink. And then we have muni bonds. So munis, typically, if you're considered an accredited investor, high net worth clients, you can typically look for tax advantages in munis, but you'll see that, munis are not immune to losses as well, especially. And then you have munis, high yield munis, which I think are the second worst performers. And that's on a 1 month. Let's see how bonds have been doing year to date. Year to date, and again, hot pink, 20-year treasuries. So this is typically a flight to safety. So everybody last year that went to the government, US government, and said, hey, I want safety, right? We're concerned about the market. We saw the volatility with COVID. That was the place to go to. But think about it. If rising interest rates are going up and the government's not keeping up, there's a flight or an exodus from that hot pink arena. And, as they go in and, people, say, hey, I don't want to be here. The remaining folks that are in those types of bonds and government bonds end up losing value, right? So again, they don't like rising interest rates, and there's an exodus for the people that are turning around and selling them. They're like, listen, I don't care if I'm taking a loss, let me get out. So this is, I think, here's the other point that I see here. People have to understand that typically bonds are designed or part of a portfolio to help generate, when we get to retirement, in income. And I always use this, hey, if we had $1 million and we had $1 million in bonds and I could get 3%, right? I could get 30 grand. And let's just say that this is all the money you're going to have for the rest of your life, and that 30 grand, and now your bond portfolio lost money. Well, now you don't have $1 million. In this example, right, you're down 20%. If you're down 20%, now you're at 800,000. And so now, now it throwing off 3%, even if the revenue stream stayed the same, right? You're saying, I want my 30 grand. It's going to eat away at the principal. Therefore, it's a death spiral. So we're not able to preserve the capital. So, I just say that, listen, typically bonds will hold value if you hold them to maturity, right? So if I actually bought the actual bond with the QSIP number, and I went and I said, I own this bond, and you held it for the term, which we'll use for this argument, 30 years. Well, in 30 years from now, whoever issued the bond, any one of these people, it's based on their full faith and credit and repaying ability, whether that be the U.S. government or, U.S. aggregate bonds, right? This is an index, but we don't actually own the bond. And that's a key distinction. But if we actually own the bond on this total return bond right here, in 30 years, I would get my money back, right? That's how a bond works. However, right? If during this we're going along a path and we were in bonds and we were, getting 3% or 4% on our bond, I come along and now interest rates have gone up because the Fed has raised interest rates, mortgage rates are up. That's an indicator that interest rates are rising. And your bond has lost value. So let's say you bought a $10,000 bond, and now you can't turn around and say, I want my 4% coupon, right? Or $400 a year, right? Paid, semi-annually, right? Or, right, you turn around and you go, I can go out to the market and get a 5 or 6% bond. Well, you have to sell your current bond. It's not going to sell for $10,000. The only way you get your $10,000 back is if you wait 30 years. So now you have to sell it, let's say at $8,000. Well, you've taken a $2,000 hit to get the higher income. That's the risk that people don't understand when you get to retirement and you build in a bond portfolio for income. So we have to be aware of that. We're in rising interest rates, but long-term, higher rates will be beneficial to most people. But it's how do we step into that area in the future, and how do we build it as part of our portfolio? So, that's just some comments on that. And then again, the bull bear chart, it's just down, right? So we've talked about it, that it's been on off a 30-year bull bond, which means bulls have been tearing up bonds. For 30 years, we've had an upward trend. Party's over, right? Interest rates are rising. We could not get any lower than zero, right? And that's where they were based on, financial environments of the government and housing crisis, Fed, COVID, things going on in Europe. There's been a lot of global exposure to bonds. And ultimately, now as things are starting to, QE, trying to print money, handing out stimulus packages, all the things that's been happening as the government is attempting to fix this problem. The reality is, how does the mechanics of the vehicle work? And that is that bonds don't like rising interest rates. That's the executive summary of what I just stated. And since we're in a rising interest rate environment, being in bonds, especially if you're in a 401k at your work, I've been talking about for months, actually years, to my clients to be careful of an overexposure to bonds. Well, it is now upon us. Does that mean you go in tomorrow and or hop online and change your allocation? I would not recommend that, right? I'm not giving you financial advice. I'm just helping you to think about this clearly so that you can start to make a smart exodus out. But, this is just the reality of last month. This month has improved a little bit, and we'll talk about that in a little bit. But what I do want to point out to you is our recession probability analytic tool, RPA. This was designed by Formula Folios and has now been acquired by Brookstone. This is a proprietary measuring tool, and we've been below 50 for a while. But folks, we crossed that threshold. That 50% means we have now entered into recession territory, which we were cautioning and said, hey, this is going to happen. But last month was brutal, just with rising gas, cost of oil, Ukraine getting invaded by Russia, a series of global events. And now I just heard that, our supply line chains are being blocked by truckers and protests. So, hey, things are going to continue to happen in the world. We cannot panic, right? That's the one thing why I do these calls, right? The media and the news and everybody that is a talking head that talks about finances, we went from an environment where, maybe you would hear about the 6 o'clock news at 6 o'clock when you got home, maybe the late evening news at 10 o'clock when you walked in the door. Now we have news 24/7. And if you sit and watch it 24/7, they need something to say constantly. They can no sooner post something because they need to say something, and it will change within, seconds. So you have to be understanding that. And what I often will caution is, I'm not saying ignore the news completely, the financial pundits, because it is good to educate yourselves. But I also find that we cannot get so buried in the gloom and doom or the greed and elation that the media feeds us, because that's what they do. If it wasn't a successful model for them, they wouldn't have so many financial channels on TV. But they all talk about it like there's a magic wand. But diversification, consistency, lack of emotional reaction are prudent advice. So folks, I am at the end of my slides. I'm going to thank you. Again, there is no call next week. This one's on business. I'm going to Minnesota and then Wisconsin for the week. So no call on Thursday. And when I come back, we're going to finish part of our series of wills, trusts, and estates. So we're going to continue that, but because I try to about the second week of the month to give us a recap from the month before, we talk about that. If anybody on this call has any questions, you want to reach out to me, feel free. I'm happy to share that with you. I want to thank each and every one of you for taking time out and reaching out. If I can help, you got questions, again, hopefully you've come to know I'm all about education, helping you to put plans in place that are well thought out and not emotional. So everybody, have a great day and talk to you soon. Bye-bye.